Normally everyone knows what an IPO is in share market. If you are new to share market and don't know what an IPO is, I made a separate video and given in the cards, you can check that. So in this video we'll see the opposite of IPO. This is also a corporate action and we will see the various reasons associated with this particular corporate action. So the term opposite of IPO is called buyback of shares. So in IPO what normally takes place is we try to buy shares from the public company, which is the company is going to be public. But here in buyback, the company will repurchase the shares which is given to us from the open market. So normally they try to buy at a price which is much higher than the current market price, so that we will be mostly benefited. The main reason for this buyback of shares is that the company is showing confidence in itself that it will perform better in the future. That is the main reason. We also have various reasons associated. We will see that. So like I said, they try to buy at a price which is much greater than the current market price, so that we tend to benefit from it. So if there is a buyback and you hold that shares, you can sell it at a much higher price and quickly book the profit. So main reason is the company might have a large cash surplus or net assets will be much higher, so they just want to buy the shares back from the open market. And we will see what is the consequence of buying the shares from the open market, why they are buying. We'll see everything. The first reason is they will try to increase the share price by buying more shares from the market. So if there are very less shares, it's obviously the share price might not decrease because there won't be much selling in the market, because if the share price is already very low in the market. So that is the second reason. The third is it improves the earnings per share. So same earnings, in the same earnings the company will make, but if you see in the open market there will be less shares. So if you divide the earnings by the number of shares which is less, obviously you get a better earning per share. So because if you see most of the big recommendations team and thing, they will consider the earnings per share. If this is good, they will ask to invest in a particular company. Because of that, the company's brand value will get increased, and there are so many other factors also for the company. They will try to get the company will be visible to the public as a good company. So that is the main reason. Next, fourth one is this is same as the earnings per share, because the term here is differs. Per share basis profitability is almost earnings per share. We will call the EPS in a different terms. So this is almost the same as the third one. Fifth one is to consolidate the stake in company. So if you see, if you don't have control in the company, some other company might come and acquire this. In order to avoid this, they will try to get more stakes in the company. That is to prevent the acquiring from other companies. They try to buy back the shares and keep it with them. They don't give the control to some other competitors or any other this thing. So these are the first six. Seventh reason is that to support the share frame from further declining the market. Suppose if price of a share is declining because of some reason, they will try to acquire the shares and stop the decrease in share price and further. So these are the top 7 reasons. We will also see what are the types of buybacks we have, how you can apply for a buyback, everything. Suppose if you have some certain shares, there will be a record date mentioned by the company, and you can if you buy the stocks within that before the record date, you will be eligible for the buyback. Let us say the price of the stock was at trading at 200, and before the record date, and the company is trying to purchase the share at, let us say, 207 rupees or 210 rupees. You can before the record date, you can buy shares of this company and try to sell at a higher price in the market. So these are the 4 main reasons and the types of buyback. And the tender basis is that it's not applicable sometimes for us. There will be some other bidding people who are bidding for that, like institutional traders and this thing. Retail traders might also participate, but mostly the first one happens in the open market. So we'll see how the buybacks impacted the share. Here you see Astradium surges 6% ahead of the board meeting on buyback. So this is the main news. And if there is a negative, if they cancel the buyback, the share price will automatically decrease. The share price might come down. So these are the various reasons of how the companies act on a buyback. And don't miss any buyback. You can go and set alerts in Google and to get your in your email alerts. So you can monitor the web for this particular keyword, buyback in India, specifically in India, but there will be buybacks in abroad also. You don't want that details, just set for Indian alerts, and you can go and buy the stocks in the record date and try to gain from this buyback event, corporate action. So this is about the buyback. I hope you got a clear idea. So the topic is over. If you want to leave, you may leave. Else, if you want the training courses, free training courses, you can listen. So you can get these courses free of cost by signing up a link given in the description of this video, or from the directly from the website using this link, and you can WhatsApp me on this number and get these courses free. Suppose if you already have an account, you can refer your friend. You and your friend both will have access to all these courses. So this is about buyback. I hope you got a clear idea. Thank you. Bye bye.